Welcome back to our FinTech series. We continue with the company profile snapshot for Scalable Capital, one of the fastest growing wealth tech investment managers in Europe. In this episode, the founders of Scalable Capital reveal 3 ways how they differentiate from traditional asset managers.
Where we differentiate versus the traditional wealth managers is that there's a big use of technology. Technology in the delivery, so fully online, very accessible. It allows us to scale the business, to keep it low cost, but also a lot of technology in the way that we manage money itself. Because what you find is that when you have human investment managers, they actually add emotional bias, which is actually a negative impact on how your investments should perform over the long term. So we're not only kind of removing the human barriers in terms of the accessibility of the product, but also removing the humans in terms of the investment management. And this allows us to scale the whole business. So we can keep it as low cost as possible. We can scale it across multiple jurisdictions. Means we can deal with thousands of clients, and we can provide each and every client with an individual portfolio. You know, it's technology that enables you to have, a small kind of group, a small company with hundreds of thousands of clients, ultimately, all with their investment portfolios aligning to their own personal goals and their own personal risk tolerance. You wouldn't be able to do that without using technology.
All the software is developed in-house, though. So that is a part that we are quite keen on doing in-house, because we believe that it's absolutely crucial to our value proposition. We are a tech firm through and through, so we're not outsourcing our mobile app development or the development of the website to anyone else. We just believe that our main difference compared to asset managers is that we're not selling a product, we're selling a service, which has a real difference in quality attached to it, basically, because we're not selling you a product in the sense of a fund that 20,000 other people could also buy. We're selling you a service, which is a tailored portfolio that suits your needs. So that's it.
The problem with the buckets is that they have no real meaning. So if you're medium risk and I'm in medium risk, what medium means to me and what medium means to you can be completely different things. And the other scaling that people use is a 1 to 10 relative risk scale. But if you're in a 5 and I'm in a 7, all that's telling you is that over the long run, a 5 should have less risk than a 7. But you're not sure how much risk. But when you use a concept like value at risk, you can actually quantify the risk that you actually care about. So one of the main risk measures in the financial markets is volatility. But volatility is kind of like just finding out how turbulent a plane is going to be. It's just saying how much noise there might be. But value at risk is focusing specifically on the worst case scenarios. So it's telling you what's the chance of the plane crashing. And ultimately, when you're investing, that's what you care about. The daily up and downs, it's important, but not as important as the worst case scenarios. So what we do is we use the value at risk. So instead of seeing a scale from 1 to 10, you see a scale from 3% to 25%. And what that percentage then represents is how much you might lose in a really bad year. And it's not just the labels we change. It's the way that we do the risk management, the way that we make changes to the portfolio that enables us to keep the risk constant over time. And that's the stuff that previously was only available to massive sovereign wealth funds who were the clients of the investment banks. And the investment banks would do this type of analysis for them, and they'd run it on their mainframe computers. And now we're using the power of cloud computing to scale that up for tens of thousands of clients. So it's not like we're reinventing anything, we're just making something which was never available to people who even had multiple millions, available to people that have tens of thousands.
So what we focus on doing is keeping risk consistent. So in our investment model, we model how much risk is in each asset class, each ETF that the client holds, and we actually make projections on how much risk they would have going forward as well. And then over time, we tie that back to the risk tolerance they've given us. If we see that they've now got too much risk in their portfolio because markets have become more risky, we make adjustments to effectively de-risk or reduce the risk and keep them back in line with what they initially specified. And that's very different from the stock picking approach, where you would pick a stock based on perceived value without really paying attention to how much risk that might take by making that investment.
We don't keep the weights consistent over time, stable over time. So 50% equities, 50% bonds. We basically are agnostic. We don't care about those weights. We look at the actual risk in your portfolio at any given point in time, and we keep that constant. And if that means that at one point you have 80% equities, 20% bonds, at another point in time you might have 50-50 or 90-10, we don't care about that. We care about the actual risk in the portfolio. So it's a fundamentally different approach to investing.
Shortlisted Productions specialise in the production of business video content for corporate clients. Please contact us for a free quote at shortlistedproductions.com.